Some investments seem to thrive despite the economy, and these stocks are at the core of what we like to call defensive investing. Fasten your seatbelts, folks. This is going to be a good one. Investing isn't only about chasing those big returns. It's also about protecting what you've already built. That's where that little thing called defensive investing comes in. Whether we're dealing once again with tariffs, heading into a recession, or maybe even both, defensive investing strategies can definitely help you weather that storm. Today, I will break down what exactly defensive investing is, why it's a must-have strategy, and when it's the best time to use it. As a bonus, I will also dive into the top two Canadian sectors that offer strong defensive plays and the two sectors you might want to avoid. So, what is defensive investing? It is all about minimizing risk while maintaining steady returns. It is the art of picking assets that tend to perform well, even in economic downturns. Yes, we are talking about those recession proof stocks. These stocks will tend to be essential industries that often come with lower betas, translating into less volatile stocks. With defensive investing, we are focusing on consistency and resilience, which will create for us some protection against market crashes. There are four key benefits to using a defensive investing strategy during economic downturns. This strategy will provide a good deal of downside protection. Markets go up and, of course, down, but defensive stocks generally hold their ground when volatility strikes. Defensive stocks will also provide consistent dividends. Many defensive stocks offer stable, high dividends, providing passive income even during the downturns. We already touched on this, but they do come with lower volatility. So defensive sectors, they're less prone to extreme price swings. And that, of course, well, that's actually pretty good on your stress levels for sure. And you know what? I'm going to add one more because these all help provide you with a better sleeping experience. Watching your portfolio drop 30%, well, that really isn't fun. Defensive investing keeps your investments steady so you don't have to panic sell. Keeping your emotions out of the equation keeps more value in your portfolio. A sub to the channel adds more value in the form of future content. We talked a little bit about what defensive investing is, but when is the best time to use it? That of course is a $1 million question, as most times it is not obvious that we are heading into a bear market. Though, when it comes to a recession, they are often easier to see via some of the economic indicators that we have out there. In the case of incoming tariffs, well, they're even easier to see. In a nutshell, if you have recession indicators, tightening economic conditions, very high market volatility, or even just an uneasy feeling towards the market, it could be the time to employ a more defensive strategy. I will also point out that this is not an all or none strategy. You can shift as much of or as little of your portfolio into a defensive strategy. Some investors will actually maintain a defensive foundation even in the good markets. It really boils down to what level of defense works for you, especially with your risk level as well. Okay, let's take a look at some sectors. So, two of the best sectors in Canada for your defensive stocks include utilities and consumer staples. Looking first at utilities, these are companies that provide essentials that include water, electricity, and gas, which are needed regardless of what the economy is doing. Utility stocks tend to be very stable thanks to, of course, regulation. And they also tend to come with some pretty good dividends, which is not too shabby for sure. Before we look at a couple, I will add that during the last bear market, we also had aggressive rate hikes, which is never a good thing for utilities as they do carry larger debt loads. As a result, the numbers we are about to look at are kind of skewed down quite a bit thanks to the rate hikes. But nonetheless, let's take a look at a few of those stocks. We will start with Hydro One. They have a ticker of H. They have a market cap of 27.30 billion. You will find that most defensive stocks do tend to be large cap. Now, we're going to look at their total return during the last bear market, basically 2022. That one was coming in at 13.78%. This one does have a dividend as well. They've got a yield of 2.76%, quarterly dividend of 31.4 cents per share. Another great company to look at within utilities is Fortis, ticker of FTS. They are one of Canada's only two dividend kings, meaning they've actually raised their dividend for more than 50 years in a row. Now, they are also a large cap. They've got a market cap of 31.04 billion. In that 2022 bear market, their total return comes in the negative 7.41%. Those aggressive rate hikes really did hurt them, but they have since recovered very well. This one does have, of course, a nice dividend, 3.96% quarterly dividend of 61.5 cents per share. The other sector that is good is, of course, your consumer staples. These are, well, they're everything from your groceries, household goods, and essential products. You know, you do have to eat in a recession for sure. Let's take a look at a few of these as well. We'll start with Metro, ticker of MRU. They're another large cap stock, market cap of 20.30 billion. In the 2022 bear market, they didn't do too bad. They had a total return of 11.70%. Their yield coming in at 1.199%, quarterly dividend of 37 cents per share. Another company in this sector is, of course, Loblaws with a ticker of L. They have a market cap of 53.84 billion, and they did pretty good in the 2022 bear market. They had a total return of 17.37%. This one also has a dividend yield of 1.15%, quarterly dividend of 51.3 cents per share. I want to add that I would normally include the railroads as top picks as well. However, with a tariff threat, they will be impacted a little more. As exports and imports decrease, it will affect their bottom line for sure. Nonetheless, I do think they will be okay. Just not at the top of their potential. Two sectors that will not do so well with economic downturns are energy and technology. With the tariffs, that 10% is going to cut into profits as most of our Canadian oil crosses the border into the US. In a normal downturn without tariffs, energy can still do well, but due to its cyclic nature and the unpredictability of oil prices, it just isn't a good sector for defense. It is very prone to geopolitical black swan events, which in oil's case tends to be sometimes a good thing for the price, unless, of course, we're talking about OPEC cutting prices. Let's take a look at Tourmaline. They have a ticker of TOU. This is another large cap company, a market cap of 25.15 billion. In the 2022 bear market, they actually had a total return of 81.26%. Holy banana bread. Yeah, they did really, really well. We'll talk about that here in a moment. They do have a dividend as well of 1.961%, quarterly dividend of 35 cents per share. So yes, they did really well during the bear market, but do you remember those geopolitical black swan events? We had a huge one in 2022. We're talking about Russia going into Ukraine. That absolutely helped the price of oil when it came to Tourmaline in the bear market. If everything had been rosy that year, they definitely wouldn't have pulled off the total return that they did. Technology is another sector that traditionally gets hit hard by economic downturns. There were, of course, some exceptions, but for the most part, tech took it on the chin for sure. We'll take a look at Open Text. They have a ticker of OTEX. They're once again another large cap company, market cap of 10.49 billion. So in the 2022 bear market, they were down by 31.69%. That's pretty bad. Their yield comes in at 3.67%. That is a quarterly dividend of 26.3 cents USD per share. Of course, as we moved into the bull market, most of these stocks did well. Utilities responded very well to the rate cuts, and I do feel they will survive whatever the economy has in store for us. Consumer staples is a no-brainer for sure, and railways could be a wild card once the tariff threat goes away, or if those tariffs are only short-lived. Defensive investing isn't about avoiding risks altogether. It's about making smarter, more resilient investment choices. By focusing on stable industries and avoiding volatile sectors, you can build a portfolio that not only survives market downturns, but continues to thrive. Keep in mind, if the economy slips and your favorite stock does indeed dip into the red, it's only a loss if you sell it. If it has sound fundamentals, it will more than likely return to the green on the other side of that turmoil. If you are interested in any of the stocks we looked at today, don't forget to put in a whole helping heaping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Dollarama. Thank you for watching, and I will see you in the next video.